Hey, if you are someone in your 20s and you're just thinking about starting your investment journey, this video is for you. Hi everyone and welcome back to Kingdom Wealth Creators. If you are here for the very first time, please do remember to subscribe to this channel. Also remember to like and share this video with all your friends and families. We hope that we can be helpful to you and them in their investment journey. Now let's look at a very important question, all right? Why should someone start investing in their 20s? What is the big reason? Why do you think it's so important? Well, one thing is that when you're in your 20s, you have time on your hands. If you can start investing early when you're in your 20s, you can start reaping the benefits long term. Over a period of time, you will see that the investments that you have made in your 20s over, say, 30, 40 years would have grown to a very large sum. You have time on your hands. I wish I had someone who would have told me when I was younger, when I was in my 20s, to start investing properly. And I didn't do that then because I did not have that knowledge. But today, I want you, as the younger generation, to understand it is so crucial and important that you start investing when you're in your 20s itself. Secondly, you have the ability to make small investments. When you are studying or you just got into a job, you might not be having a lot of money, but that 500 or 1000 that you put in regularly into investments would make a huge difference, say 40 years down the line in your future. For me to match the same, today I'm about to hit 40 by the way. For me to match the same, I would have to put a larger chunk of money as investments to match what you would put in at your 20s. For example, if you were putting in 500 each month right now when you're 20, and say 40 years down the line, you've invested regularly like this for 40 years, you would be looking at a return of almost 2.2 crores, somewhere in that ballpark figure. For me to match that same return, I would have to be putting in roughly 10,000 to 15,000 a month from here on to reach that 2 crores return when I'm 60, 65. So this is the challenge that you have the older you get. When you are young, it is easier. If you can start small and start doing it on a regular basis, you will see a great return down the future. So now that we've looked at the why, it's time to look at the how. And before I start on the how, I just want you to know that this is my personal approach to how I do my investments. It is important that you find what suits you the best, because it is not that one size fits all. Everybody has their own tailor-made way of investing, what they're very comfortable with, and that is why you should find what is best suitable for you. But let's look at how should we do investments. Well, the answer is very simple. It is systematically and for the long term. Today a lot of young people are enamored by these YouTube videos and Instagram posts where you see people making lakhs of rupees every single day, and they assume that it is so easy to get very rich very quickly on the stock market. Well, I want you to know that it's only about 1% of the total traders on the stock market who actually make consistent returns on a daily basis. A lot of people lose money because they trade every day. So the answer to how you should invest when you're in your 20s is to do it systematically, every month, do it regularly, and for the long term. Because when you do it for the long term, it actually helps you utilize the power of compounding. I already mentioned that if you were to put 500 each month into some sort of investment, and if you were seeing a return of 15% annually, you will notice that after the end of 40, 45 years, you're sitting at 2 crores. You started with 500 rupees a month. At the end of 40, 45 years, you're looking at 2.2 crores, which is safe enough or good enough for your future once you retire. And so it's so important. If you can do that when you're small, when you're young, it really pays off when you get older. So then the next question some people might ask is, why do you keep saying 500 and 1000? Can't I just invest 10,000? Can't I just invest 1 lakh a month? Well, that's up to you. Okay. But I do know that as a typical 20-year-old, we don't have 10,000 and 50,000 and 1 lakh lying around every month to invest. So that is why I suggested 500 to 1000. You can, up the gambit the more comfortable you're with, depending on your lifestyle, depending on your income. That's all up to you. But here's my general rule of thumb that I use when it comes to investing. Again, this is my personal choice. It can vary from person to person, it can vary for you. But what I normally do is I will look at my income, I'll look at what my needs are, and I'll allocate accordingly to fulfill my needs. I would typically put 20% of or more into investing, and the rest I would try to help people with whatever I can or however I can. And nowadays, as my income has grown, I gradually have seen that I typically put around 50 to 60% of my income back into investments, and then I fulfill my needs and give away money to others to help with the rest of the 40-50%. When you're starting, when you're 20, you won't have the bandwidth or the income to meet all your needs with just 20%. It is going to be more like that you're going to need 50 to 60% to meet your needs. But it is important that you think of at least saving 20% in investments each month. So the next question, we already covered the why and the how. Let's look at what should I invest in. Well, first off, we should learn to invest in ourselves and our families. We should continuously update our skill sets. We should work on our health. We should take care of what we eat and what we do with our lives, and be prudent in all sort of things. But one of the things that I want you to know in terms of investing is, especially because of these last 2 years of COVID and all the challenges that we faced, is to make sure that you have your health insurance or medical insurance and your life or your term insurance covered. Now, if you're working in a company, it's highly likely that you would have some sort of a corporate medical insurance already available for you and your family. But it is good to also take your own personal medical insurance covering you and your family, simply because that will get you into the lifestyle of making sure you have that covered. And if you or someone in your family are the only breadwinners for the family, make sure that they or you are covered with a life or a term insurance, because nowadays we know it can be a disability or a life-threatening disease that comes your way, or God forbid, even death that can come at any time. And it is important that the family does not lose out on the income source that they had when the breadwinner was alive or fully able. So it is important that we have life insurance. For a person who's earning, say, around 5 to 10 lakhs per annum, I think it's important that you get at least 1 crore of insurance coverage, of life insurance coverage, simply because that will make sure that your family is protected even if you lose out on that source of income. Now that brings me to this next question of, what about fixed deposits? Okay, should I invest in fixed deposits? Well, I'm not a big fan of fixed deposits. I know that the older generation would have tended to park all their money into fixed deposits, but look at it. For example, fixed deposits today typically see a return of somewhere between 4 to 6% per annum, and the inflation rate in India is already between 5 to 6%. So meaning your FD on a net to net basis is actually not even enabling you to beat inflation, which means we should stop parking our money in FDs unless you're very old and you're retired and you want to make sure that your money is safe. If you're younger, especially when you're 20, you should never be putting your money into FDs. What you should be doing is either invest it into the stock market directly, or if you don't have time, you're very busy, your work is consuming a lot of your time, you don't have time to research, you don't have time to look at what good stocks are available to buy, you can also put it into a Nifty link or index linked mutual fund, something that will give you the same return as the index over an annualized basis. And that really helps. Okay, so stock market is the best place to invest in. If you're investing into the stock market, if you have time and the ability to do research, you can go for specific stocks that you can tend to buy low and sell high, or you can look for an index-based mutual fund, which would give you the same return as the index, but without you having to spend a lot of time doing all the research. Another place where you can make your investments is definitely gold, right? I know that every Indian family loves gold. A lot of our parents and our grandparents have invested into gold over time. But here's a few things that I want to share to you about gold. Okay, when you buy gold in the physical form, you have to pay a lot of charges to get it, made into a, whatever form of jewelry that you want. Then there's the cost of protecting it. There is the risk of wear and tear. There's a risk of getting robbed. There's a risk of a fire involved where your jewelry gets melted, or it gets misplaced and all of that. But today what I would recommend is, instead of actually buying gold in its physical form, go and buy gold in the sovereign gold bond form. Now the SGB is freely available on every broker. If you have a demat account, you can definitely buy SGBs on whichever trading platform that you have. And the good thing about SGBs, or sovereign gold bonds, is this: first, it will appreciate along with the appreciation in the gold market. So if your gold, 1 gram of gold is rising to about, say, 5,000 rupees, the SGB value will also grow accordingly. Secondly, the Indian government, which issues these SGBs, are also providing a 2.5% interest rate over and above the appreciation in the underlying gold value. Meaning, you not only will you profit from the gain or the appreciation in the rise of gold prices, but you also get 2.5% interest rate beyond that. The fun fact about SGBs is that it is in demat form, meaning it is on your trading account. Nobody can come physically steal it from you. Neither do you need to protect it in a cupboard or in your locker or in the bank or anything like that. And it's so easy to carry around. It's on your demat account. Imagine if you wanted to carry 1 kg of gold around. The risk that you would have to take, the anxiety that you would have, the worry that you would have that someone would do something to you because they know that you're carrying 1 kilo of gold. But today you can carry that 1 kilo of gold in SGB format and have no fear that somebody would steal it from you. Thirdly, the next area that I would look at investing, especially when you're 20, it's okay to take a lot more risks, is the crypto market. If you can start investing into cryptocurrency, which is something that will eventually become very common throughout the world in terms of transactions, that is a good place to start as well. Now, I wouldn't suggest when you're young to put all your money into cryptocurrency because it's highly volatile. But what you can do is, say, set aside 5 to 10% of your total investment, put it into some stable cryptocurrencies like the largest ones, Bitcoin or Ethereum or Solana, or Cardano, or Binance coins. These are cryptocurrencies that I also have invested in personally. By putting that in and just staying invested, you're going to see them appreciate over time, and that also can add to your future protection, because those cryptocurrencies will also grow. So the next question, we have covered the why should I invest when I'm 20s, how should I invest, and what should I invest in. But where do we invest this in? Well, if you're looking to invest in the stock market, the first thing you need to do is start a demat account. Now, I personally use Finvase and Zerodha as my trading platforms. This is not a promotion of either of these brokerages or these platforms. It's simply because I'm very comfortable using them that I'm telling you that these are the 2 platforms that I use. You can start a demat account with any platform that you trust, and then you can start investing through them. Secondly, when it comes to my cryptocurrency investment, I personally use Vault, because in Vault you have this additional feature where the cryptocurrency that you buy, you can also put it into an FD and get a good return on it. Again, this is not a promotion for Vault. It is simply because that I'm very comfortable in using it. I feel that it is well regulated and there is a good safety margin for this particular trading platform, and that's why I use it. So then you might ask me, hey Sarjan, you just, in the beginning of this video, you said you're against fixed deposits, but now you're saying that, if you're investing into cryptocurrencies, use Vault and you park them into FDs. Well, the reason is simple. If I have 1 lakh rupees in my bank account and I put it in my bank account, I'm not going to see any other return or appreciation on it. 1 lakh rupees is going to stay as 1 lakh rupees. Now, if I put it in an FD, I might get 5 to 6% return on it, and that is about it. But when it comes to cryptocurrencies, when I invest into cryptocurrencies through Vault, one, the cryptocurrency itself can appreciate. So if I invest, say, 1 lakh of rupees into a particular cryptocurrency, say Bitcoin, when Bitcoin appreciates, that 1 lakh in rupees will grow in value, right? Secondly, that cryptocurrency itself I have put into an FD, and usually for Bitcoin the return is 6.7%, which is again better than our inflation rate. So now I have a base investment of cryptocurrency that will appreciate on its own. Plus, there is an additional FD that's going to generate an additional income or revenue on that same base investment. So that is why I think it's very good to do FDs on board for cryptocurrency, because cryptocurrency by itself will also appreciate. So finally, the last question. We covered the why, we covered the how, we covered the what, we covered the where. Now it's time for the when. When should I start investing? Well, we already said, in your early 20s, start as early as possible. Do it systematically. When means don't do it like once in a blue moon, like once in 2 years or something like that. Do it every month. Set aside that 20% or 30% of your income, put it into investments. I have noticed something that I'm not sure a lot of people know, and a lot of people probably don't say this out aloud. But when it comes to the Indian stock market, one of the things that we notice is that on the last Thursday of each month, it is the expiry date for futures and option contracts. And typically on that day, either the market would be at the lowest point for that particular month, or it might fall a bit. And so what I've seen, the best day to invest in any particular month is usually the last Thursday of that month. But again, this is something that is very subjective. You're very free to start investing whenever you want, whether it's the 1st of the month, the 30th of the month, the 15th of the month, or you're the 7th or the 10th. It doesn't really matter. But this is one tip that I hope can help you when you decide when to invest. What I tell people who ask me this question personally is, look for the last Thursday of that month and put in your SIP or your amount that you want to invest, and do that on a regular basis. So I hope this has helped you plan your investment journey better. This step-by-step guide will really help you. If you're someone who hasn't started your investment journey and you're in your 20s, I hope this inspires you to kickstart that journey, because you will definitely reap the rewards of that journey when you're 60 or 65. So please do let us know if this has helped you, and also if there is anything else that you would want us to talk about in the coming videos, please do put that in the comment box. We will definitely do that. Our aim is simply to help you better your investment journey. So thank you so much. I hope to see you the next time as well.